Welcome to TheoTrade. This is Don Kaufman. Here we are. It's December 11th, 2017. Today, activity is to the upside on what has amounted to some fairly light trade. Really, the only defection today happens to be from the Russell, so the small caps are kind of defecting to the downside, along with the financials. So the financials are weak on a relative basis. You see the XLF down about 0.5% today, and that's something I will be watching very, very closely in the days to come. Obviously, we have the FOMC coming out this week. We have the ECB. We have the Swiss National Bank. All right, I mean, the Bank of England. Everybody that has a Fed has got something ultimately to say this week. So I figured tonight was the perfect time to discuss an upcoming course for all of you that are members here at TheoTrade. We've got a class, and it is coming up this Saturday, December 16th. It's from 10 a.m. to 1 p.m. Eastern time. And I want to describe to you guys a little bit about the strategy that we're going to be discussing this, again, coming Saturday. So a little preliminary discussion of this. What you're looking at right now on your screen, and I'm going to kind of maximize the chart, happens to be none other than a 20-year monthly on the spiders. And, you know, one thing that really comes to mind when you see markets just kind of chugging along each and every day to the upside over here, really, really light volume, you know, I kind of step back from it and I continually think about all of our clientele that have just tremendous exposure to the overall S&P 500. Now, that's not necessarily true of everybody, but I mean, you start thinking about this, and if you have a 401k, all right, if you have an IRA, if you're in anything right now other than maybe cash, and you could probably make an argument even cash has risk because of inflation, but in roughly any investment that you have right now, you've got risk. Most people, though, their risk kind of corresponds to the S&P 500, and that's why, you know, I looked at this in terms of the spiders. And the reason I brought up a 20-year monthly over here is I really started my trading career in the late 90s in Chicago. And I've been through some fairly, you know, tumultuous times over here where I was already working at the time, which was a startup brokerage firm called thinkorswim, in the time where the Nasdaq collapsed right in here. I saw lots of people lose 50% plus of their investment. You know, obviously I was actually running the education division of thinkorswim at the time of the crash in '08. And there I saw people losing 60, to 70% of their portfolio. It was right in this time frame here at about 2010 where I actually took over the education division of TD Ameritrade. And, in 2011, everybody kind of forgets this, in 2011, we actually felt for a short amount of time that we were actually headed back into a financial crisis. And, there's this incredible complacency right now. And let's not talk about, even for a second, where you think the markets are going to go. Like, just, check that baggage at the door and recognize all I want to discuss is a hedging type strategy that I'll go into more detail again in this class. But, you just have to understand that this is not just about, mom and pop with a covered call. This is about people that just don't recognize that overnight, markets can drop easily 10, even 15%. And I got to tell you, so, I'm sitting here and I'm watching markets grind to the upside once again. And it's just, I wouldn't be doing anybody any justice if I didn't spend some time talking about hedging what is ultimately your life savings. We talk so much about trading, and everybody comes here and watches videos, whether it's on YouTube, because they want that instant coffee, instant tea. They want to learn how to make, a couple of bucks here, a couple of bucks there, a few 100% here or there. And yet we let the 401k, the IRA, our retirement kind of go again, I guess, unchecked, and it falls by the wayside, and people just have huge risk. So with that, I'm going to discuss a little bit of what I call kind of the atomic hedge, and I'll explain that again in quite some detail over here. what you're looking at just happens to be a risk graph, right? And this is the risk graph if I had owned 1,000 shares of the spiders. Now listen, the size of the position is neither here nor there, okay? The thing is, I just put a risk graph together here. And again, with this risk graph, what is it? Well, if the market sells off, you got risk. If the market sells off big, you got a lot of risk. I mean, here's the market sitting at about, in the neighborhood of about 266, and that is the spiders. And if the market backs off back to 250, and this is just a portfolio again of the equivalency of 1,000 shares, right? So if it's 1,000 shares, portfolio is worth what? Oh, $15,000, $20,000 less if the market just backs off a couple of points here. So again, it's kind of a stark reminder of the risks that loom in a marketplace. Obviously, if you want to see like what your risk would be with like, a 10% decline in the market, you can come over here and do what's called set slices. And you can set slices, and this gets a little crazy, but here, you can see all these like various lines in the screen. What if the market goes up 2% or down 2% or down 4% or down 6%? Oh my, it's crazy, right? So let me go ahead and reset the slices and just make a brief point. In a marketplace like right now that's just been chugging along, nobody ever wants to look at the downside risk. A 10% move to the downside takes us square down to about 240 almost on the button. And all I'm showing you here, again, in these slices, okay, that's a 10% decline. On a 1,000 share portfolio, that's the equivalency of losing, just about $26,000. I mean, that would be the effective loss, about $26,000 if you owned about 1,000 shares of the spiders, but just a 10% decline. And you can kind of play around with this a little bit and have some fun with it. But, what happens if we had a 15% decline, okay? And you can take a look again, where does the 15% decline fall? Well, I got to zoom in some more screen for that. That takes the spiders down to about 226. And then you're staring down the face of almost a $50,000 loss on on about 1,000 shares of the spiders. Now I know that if you're tuning into this, listen, Don, I don't own 1,000 shares of the spiders, but that's fine. Okay, I'm just using this again to be representative, like what your portfolio might be. Maybe you only have 100 shares of the spiders. And I keep talking about the spiders because somebody over here, they've got a 401k. Right? And that 401k, it's got mutual funds in it. And I know that the 401k is isolated. It's like a little bubble boy, right? And the 401k, it's got mutual funds. They may have like a Vanguard 500. It's got they love to do this, the 2040 fund. What's the 2040 fund? Assuming you live to 2040, that's when you'd retire. All of these portfolios are really representative of the spiders. Maybe some people have some tech portfolios. Well, instead of looking at the spiders, then you could look at the Qs, okay? Or you have emerging markets, which could be like EEM. But the point I want to make is, here's a really, straightforward idea. Not the most simple idea, but the most straightforward idea into mitigating your risk. And that's, again, it's a type of a hedge. What we could do out there is we could turn around and we can buy puts. Now, this is not exactly like, brain surgery over here, buying puts. For instance, we could turn around and we could buy, and you'll see it right down below here, a 260 put. Okay, don't worry about what we're going to pay for it. We're going to buy a 260 put. What does a 260 put give us the right to do? It gives us the right to sell the spiders at 260. And right now, the SPY, okay, is at what? 266. So this is what I mean by like definitive downside protection. You own the spiders at 266, but you have the right to sell the spiders at 260. If they go down, okay, can you lose $6? Yes. Nevertheless, you have hedged or reduced risk of anything below, okay, the level of 260. And that's what a 260 put does. Now, assume that you never really owned the spiders, okay? If you just had a 401k, you could still buy the 260 puts. It gives you the right to sell the spiders, but you're like, but I don't even own any spiders. But it doesn't matter. The 260 puts, okay? Let's say that the marketplace went from here and jumped all the way down to 220. The 260 puts, okay, are worth what? with the underlying trading at 220? Well, they're going to be worth at least $40. At least $40. So instead of selling the spiders for 260, we just bank the $40, right? We just take the money out of it. Now, here's the issue with this entire scenario. Okay? The issue with the scenario is that these 260 puts, they're expensive. They're really expensive. So we want to have this definitive downside protection. We want a line in the sand. I want to make sure that no matter what happens to this marketplace in the next month, the next year, the next week, the next day, I want to make sure that you have a floor under you. Okay? That if the bottom drops out, that you have a definitive downside hedge. And that's what that 260 put provides. But at the same time, the cost of the put is so prohibitive. So we're going to teach you, okay, this coming Saturday to finance the cost of the put by selling some spreads against it, selling call spreads. Now, this doesn't cap all of your upside. It caps some of the upside, but not all the upside. See, in any hedge, in any risk reduction strategy, you have to be willing to give up some of the upside to control the downside risk. And this kind of is what the resulting risk graph is ultimately going to look like. So we'll do a little bit of a before and after picture here. Okay, here being the after. I'm going to zoom in real tightly on this, and I'm actually going to show you what it looks like kind of on a day-to-day as the trade ultimately matures. Okay, kind of day by day through here. So again, all we're doing is a risk mitigation tactic. And when I said I wanted to put a floor in, I want to make sure that you can't lose more than X amount of your portfolio, but I still want to leave you with ample upside opportunity. Okay, what you're looking at is the risk graph, and the risk graph is showing you different dates in time. Now this hedge, this risk reduction is done out in February. Does it cap some of the upside? Yeah, a little bit. Okay, but the way I see it, there's still tremendous upside potential because we don't know if the market's going to continue to the upside right now. Okay, there's a tax plan on the horizon. There's, government spending over here. They got to fund the spending bill. There's just too many risks and too many upsides to even possibly quantify. But one thing that's nice, we're going to quantify our downside exposure. And in this particular case, even on 1,000 shares, all right, we're not losing much more than about what? $1,000, for what? For downside over here per point, which again, the maximum sustainable risk, $1,000 per point, down for a maximum risk of less than $6,000. You realize in this little simulation over here, okay, in this simulation, I'm simulating 1,000 shares of the spiders, which is effectively what? $266,000. Okay, I've limited that right here to the biggest drawdown would be $6,000. That's the biggest portfolio drawdown we could see, which would be right around $6,000. Or, as I said, the maximum exposure would be about $1,000, okay, per $1 move in the spiders for a maximum risk of $6,000. And I always question this kind of stuff. Why don't more people do this? Again, most of the upside, almost none of the downside risk. That's what we're going to be looking at again this Saturday. I want to thank everybody for joining us here at TheoTrade. It's kind of been a slower trading session. Have a great evening, everybody. Bye-bye.